OG John AG here. Gold moved $311 today. That's the largest one-day dollar gain since 2008, a $2 trillion shift in a single session. Roughly the entire market cap of Amazon. No CEO, no earnings call, no board meeting. Just the oldest money on earth reminding you it's still here. Gold is up 6% today, or $286 per ounce. Silver up 14%. When gold, silver, and copper pump together, it's not speculation. It's the system repricing what money actually is. Jesse Livermore called this the market telling you something. Smart money listens before asking why. But here's what nobody is connecting. Physical silver is near impossible to source right now. Bullion Star just posted, the physical market is under serious stress. Silver especially, near impossible to source. Mints closed, refineries backlogged, most competitors empty. They have inventory because they planned ahead. That said, premiums are set to reflect real physical market conditions. They've reduced both buy and sell minimums from 20,000 to 10,000 Singapore dollars and will continue to monitor. Access to physical metal matters, especially during times like these. In yesterday's video, I mentioned the possibility of a move toward $87 to $90. Why that zone? At the time, we were trading around 80, and that level represented a key confluence of technical factors. We didn't hit it yesterday, but today, price touched that zone and rejected. I can't fully break down why that area was so important here. That's a whole separate video. But that's our approach on this channel. We examine both scenarios with real data. No hype, no greed, no fear. Just authentic analysis and a solid plan. If this is helping you, hit subscribe and drop a comment with OG John AG so I know the real community is here. Remember, about 70% of this channel are long-term investors, decades-long stackers. Some are short-term traders. That's why we sometimes cover both angles, the physical reality and the paper market. Whatever your style, the goal is the same, to plan, not to gamble. Currently, as I'm recording, silver Western spot and futures at $85, Shanghai spot at 100, Shanghai futures at 101, Shanghai premium $15, 18% premium. A few days ago, I made a video discussing a critical technical level. If the price closed below the 150 exponential moving average on the hourly chart while we were trading above $100, we could see the early 90s as potential support. The price initially bounced, exactly as we discussed. Then I followed up with another video about the Fed chair's potential impact, how it could push us even lower, potentially below $86. For many of you on this channel, that perspective was very helpful. Let me be crystal clear. It wasn't a signal, it was a scenario to plan for. And as we saw, it played out. Now here's the critical technical level everyone needs to understand. The 150 EMA on the hourly, which we used for the 86 and below call, is now currently at $96. And after this 18 to 20% bounce in silver from its lows, I'm hearing people call this a bottom. I don't know if it is. I don't pick bottoms or tops. And I'll say it loud, no one does. It's funny to see some copycats even claim they have insider access, with thousands watching them. At this point, it's more entertainment than analysis. Here's what the technical picture is telling us. A total washout of contract open interest usually correlates with lows. With February 26 off the board and into delivery, a lack of rolls plus liquidations dropped the total COMEX gold open interest to just 414,756 contracts on Monday. That's the lowest total since June 9, 2025. Also note the open interest drop in COMEX silver. As of Monday, it fell to 142,368 contracts. That's the lowest total open interest since May 20, 2025. Open interest at multi-month lows typically signals capitulation. Weak hands flushed, leveraged longs liquidated. But the 150-hour EMA is now at 96, acting as resistance instead of support. We're at 85. $11 below that key level, the 87 to 90 target I called. We hit it and got rejected. That rejection matters. It tells you there's resistance there. Bulls tried to push through, couldn't hold, got pushed back down. Let's look at both sides. Bearish case first. The 150-hour EMA at 96 is now a downward sloping resistance. When support becomes resistance, that's a bearish flip. We tested 87 to 90, got rejected, came back to 85. If we can't reclaim 90 and hold, the next test could be lower, potentially retesting the 71 low. Bitcoin dropped below 74,000 for the first time since April 2025. Risk-off sentiment spreading. S&P 500 closed down 0.8%. Nasdaq declined 1.5%. Wall Street Fear and Greed Index at 39. We are back in fear territory. Global bond yield spiking. German 30-year bond yield climbed to highest level since 2011. U.S. 10-year Treasury yield approaching the highest level since August 2025. Japanese 10-year near the highest since 1999. This is systemic stress. When bond yields spike globally, everything else sells, including metals initially. And there's geopolitical risk escalating. Reports of U.S. at war with Iran, breaking headlines. If true, that's a major catalyst. But initial reaction to war is often risk-off. Sell everything, raise cash, wait for clarity. Only after does the safe haven bid kick in. So if geopolitics worsen, we could see more volatility before the sustained rally. That's the bearish case. 150-hour EMA at 96 is resistance. Rejection at 87 to 90. Risk-off sentiment. Bond yields spiking. Bitcoin breaking down. More downside possible. But here's the bullish case. Physical silver is near impossible to source. Mints closed, refineries backlogged, competitors empty. Bullion Star had to lower minimums from 20,000 to 10,000 just to maintain access. This isn't paper volatility. This is physical scarcity. You can't fake closed mints and empty refineries. When physical is this tight and paper is at 85, the disconnect is extreme. Central bank gold demand remains incredibly strong. Central banks purchased 328 tons of gold in 2025, just below the 345 tons bought in 2024. Poland led with 102 tons, followed by Kazakhstan with 57 tons. Gold acquisitions by central banks have continued for 33 consecutive months, 33 straight months of buying. The 12-month moving average stands at a massive 27 tons. The central bank gold buying supercycle shows no signs of slowing, regardless of price fluctuations. David Hunter raises gold price target from 5,500 to 6,800, raises silver price target from 125 to 180. That's a credible analyst raising targets while everyone else panics. COMEX open interest at multi-month lows. Lowest since May for silver, June for gold, washout complete. When open interest craters like this, bottoms form. Not always immediately, but the forced selling is done. The weak hands are out. The leveraged longs are liquidated. Gold price during Germany's hyperinflation from 1914 to 1923. Gold price went up 1 billion times. Monthly volatility ranged from negative 30% to plus 160%. Even with perfect foresight, one would have experienced gut-wrenching volatility. This is normal in precious metals bull markets during currency crises. The volatility isn't the problem. It's part of the process. Fundamentally, the gold bull era is 100% intact. The story being told by mainstream media is that because a new Fed boss will supposedly keep its decision-making independent from that of the U.S. government, gold needed to fall $1,200 per ounce and silver needed to fall $50. In a nutshell, the story being told is 100% nonsense. 3 billion gold-obsessed citizens of China and India, and a small band of savvy Western gold bugs, don't need central banks because their focus is on building glorious savings in gold rather than adding more fiat and debt. In the big picture, the bull market thesis doesn't hinge on who runs the Fed. It hinges on whether the underlying fundamentals, debt levels, currency debasement, physical supply-demand, remain intact, and nothing in those fundamentals has changed. The 5,600 area in gold and the $70 area in silver have historical significance as previous support levels. The silver crash was amplified by leveraged positions getting liquidated, which is typical in volatile bull markets. Gold bottomed around 4,400, while silver found support around 70. Whether those levels hold long-term requires more data and price action to confirm. Chinese yuan hit strongest level against the US dollar since May 2023. Yuan strengthening while dollar weakens. This supports higher gold and silver prices in dollar terms. The pricing power is shifting east, China accumulating. Central banks buying 33 months straight, physical impossible to source. Mints closed, refineries backlogged, and paper is at 85. So is 71 the bottom? Here's what I'm watching. If we reclaim 90 and hold above the 150-hour EMA at 96, that's bullish confirmation. The bottom is in, and we're heading higher. If we fail to reclaim 90 and start testing 80 or below, more downside is coming. The 87 to 90 rejection matters. Bulls couldn't hold it. That's a warning. But physical scarcity and central bank buying say the fundamentals are overwhelming the paper manipulation. Current prices, Western Spot 85, Shanghai 100, $15 premium, 18%. After a 40% crash, the premium is compressing but still elevated. Physical is still trading above paper. Mints are still closed. Refineries are still backlogged. Open interest is at multi-month lows. Gold just posted its largest one-day gain since 2008. These are not normal conditions. So where does this leave us? Number 1. I called 87 to 90 in my previous video. We hit that target and got rejected. We're back at 85. The 150-hour EMA is now at 96. That's resistance, not support. We're $11 below it. Is 71 the bottom? Drop your thoughts in the comments. We need more data. Number 2. Physical silver is near impossible to source. Mints closed, refineries backlogged, dealers lowering minimums just to maintain access. Central banks buying 33 straight months. COMEX open interest at multi-month lows. David Hunter raising targets to 6,800 gold, 180 silver. These are bottom signals. Number 3. Gold moved $311 today. Largest one-day gain since 2008. Silver up 14%, but Bitcoin's below 74,000. Bond yields spiking globally. War with Iran escalating. The volatility is extreme, but that's normal in currency crisis bull markets. The unresolved tension. Physical impossible to source. Central banks buying relentlessly. COMEX washout complete. But we got rejected at 87 to 90, and now sit at 85 with resistance overhead at 96. Is this the bottom, or do we test lower first? You tell me. Is this where we turn, or is more pain coming before the rally resumes? Do your own due diligence. Understand the risks. The technical picture is mixed. Rejection at 87 to 90 is bearish. Open interest washout and physical scarcity are bullish. 150-hour EMA at 96 is key resistance. We're below it. If we reclaim it, bullish. If we fail, bearish. The physical market says the bottom is close or already in. The paper market says more volatility possible. But here's what matters most. This is war-driven price action. Geopolitical events are unpredictable. Headlines can reverse in hours. What looks like a breakout today could be a bull trap tomorrow. Leverage kills in markets like this. Even physical holders need to understand that premiums can collapse as fast as they spike. Nothing is guaranteed, not the bottom, not the bounce, not the breakout. Now, if you're a long-term stacker with a time frame of years or decades, this is noise. Daily swings, hourly charts, EMA tests. None of it matters if your thesis is monetary debasement, industrial demand growth, and central bank accumulation over the next 5 to 10 years. For stackers, the only question is, can you source metal and is the premium reasonable? Everything else is just volatility you ignore. But if you're trading, if you're using leverage, if you're playing short-term moves, then every level matters. Know which signals you're following. Know your risk tolerance. Know what you can afford to lose. And if you're using leverage or trading derivatives, understand that this volatility can wipe out accounts before you have time to react. Plan for the worst. Hope for the best. But never ever assume you know what happens next. Invest with logic, not hype. Use your own brain, don't follow anyone blindly. OG out and about. And